There's a three-digit number that follows you around for your entire adult life, and almost nobody has ever been told how it actually works. It decides whether you get a mortgage. It decides your interest rate on a car. It decides your insurance premium. In some states, it decides whether you get hired. And for most people, the entire understanding of this number comes from a mix of half-remembered advice from their parents, random TikToks, and whatever their credit card app told them last Tuesday. Here's the part that should break your brain. The average American has a credit score sitting somewhere around 714. Good, not great. But most of those same people have absolutely no idea which of their actual behaviors moved that number up or down. They think carrying a small balance helps. It doesn't. They think checking their own score hurts. It doesn't. They think closing that old credit card they never use cleans things up. It does the opposite. So today we're going to fix this. For good. I'm Mr. Bandage. I patch up financial wounds for a living, and if your credit score is bleeding out because of bad advice, this is the triage room. I've watched hundreds of people do everything right on paper and still watch their score refuse to move. Because they were optimizing for myths. If you've ever stared at your credit app, paid everything on time for months, and watched the number go up by one depressing point, this video is for you. Stick around, and if you want more straight talk like this, hit subscribe. Your future self with a better mortgage rate will thank you. Quick note before we start. This is education, not financial advice. Do your own homework before any big money moves. Here's what we're going to do today. I'm going to walk you through the 5 actual factors that move your credit score, in order, with the exact percentage weight each one carries. Then I'm going to demolish the 8 most common myths that are costing people real money. And by the end, you'll understand this number better than 90% of the adults around you. Let's start with something most people have never seen. Your FICO score, which is the score 90% of lenders actually use when deciding whether to approve you, is built on exactly 5 factors. Not 7, not 10, 5. And each one has a specific published weight. Factor 1. Payment history. This is 35% of your entire score, more than a third of the whole thing. All payment history asks is one simple question. Do you pay your bills on time? That's it. Credit cards, car loans, student loans, mortgages, personal loans. If it reports to the credit bureaus and you pay it on time, you are feeding the single most important part of your score. Here's where it gets twisted. A payment being 1 day late usually does nothing. Most creditors don't report a late payment to the bureaus until it's 30 days late. That's the cliff. Go over that cliff once and you can lose anywhere from 60 to 110 points overnight, especially if your score was high to begin with. One late payment, 30 days, up to 100 points gone, and it stays on your report for 7 years. Let me introduce you to Marcus. Marcus is 34 years old, makes $82,000 a year working in logistics, and has a credit score of 760. He's financially responsible. He auto-pays everything. Except 1 month he switched checking accounts. His auto-pay for a $600 credit card bill bounced. He didn't notice for 35 days. His score dropped to 670 in 1 month, from very good to just average. And when he tried to refinance his mortgage 8 months later, he got offered a rate a full percentage point higher than his neighbor. On a $400,000 loan, that one slip is going to cost Marcus about $2,400 a year. For 7 years, do that math. This is why payment history matters more than everything else combined, basically. Pay on time. Set up auto-pay. Check that auto-pay every single month because banks swap routing numbers and cards expire and life happens. Factor 2. Amounts owed. 30% of your score. And this is where it gets counterintuitive. Amounts owed is not really about how much money you owe in total. It's about something called credit utilization, which is a fancy way of saying of the credit you have available, how much are you currently using. Here's the example. You have 3 credit cards, total combined limit $10,000. This month you spent $3,000 on them. Your utilization is 30%. If you spent $5,000, it's 50%. If you spent $9,000, it's 90%. Here's the part nobody explains. The credit scoring models are watching your utilization on a monthly basis, based on whatever the balance is when your card issuer reports to the bureaus. For most cards, that's your statement balance, not your actual balance on the 15th of the month. The statement balance, which means even if you pay your card in full every month, if you charge a lot between statement dates, you can still look like a high utilization borrower to the bureaus. People with the highest credit scores, the ones over 800, almost all keep utilization under 10%, not 30, 10. Below 10% is the elite zone. Between 10 and 30 is fine. Above 30, your score starts bleeding points. Above 50, it's a wound. And here's the trap nobody sees coming. Utilization is calculated 2 ways. There's overall utilization across all your cards combined, and there's per card utilization for each card individually. Both matter. So if you have 4 cards with low balances and 1 card that's maxed out, that one maxed card is dragging your score down even if your overall utilization looks fine. Factor 3. Length of credit history, 15% of your score. This is where most of the damage from bad advice actually happens. Length of credit history measures 3 things: the age of your oldest account, the age of your newest account, and the average age of all your accounts combined. Longer is always better. A person with a 20-year-old credit card will almost always score higher than a person with identical behavior but only 3 years of history. Here's why this matters for the advice you've probably heard. Somebody told you to close that old credit card you never use. It's clutter, they said. Simplify your wallet. Don't do it. When you close a card, especially an old one, you just shortened your credit history, potentially by years. You also reduced your total available credit, which jacks up your utilization percentage. It's a double punch. One dumb decision, 2 hits to your score. The exception, and it's a real one, is if the card has an annual fee you can't justify. Then you might consider keeping the account open and downgrading to a no-fee version with the same issuer if they offer one. That preserves the history. Factor 4. Credit mix. 10% of your score. This one's simpler than people make it. Credit mix asks, do you have experience handling different types of credit? Revolving credit like credit cards. Installment credit like car loans or student loans. Mortgages. A healthy mix across these categories helps your score. It's not a huge factor, but it's there. Here's what you should not do. You should not take out a loan you don't need just to improve your credit mix. The points you'd gain are not worth the interest you'd pay. This factor mostly takes care of itself as you go through life. You'll have a credit card, eventually a car loan, maybe a mortgage. The mix builds naturally. Factor 5. New credit, 10% of your score. Every time you apply for new credit, it leaves a little mark on your report called a hard inquiry. One hard inquiry usually costs you around 5 points. It stays on your report for 2 years. It affects your score for 1 year. Multiple hard inquiries in a short period look bad. Scoring models assume you might be desperate for credit, which statistically is correlated with defaulting on loans. So if you apply for a new credit card, then a car loan, then another credit card, all within 2 months, you're going to see your score take a hit. Here's where it gets more nuanced. When you're shopping for a mortgage or a car loan and you apply to multiple lenders within a short window, usually 14 to 45 days depending on the scoring model, those inquiries get treated as a single inquiry. Because the scoring models recognize your comparison shopping, not drowning. So shop around. You won't get punished for it. That's the full picture. 35, 30, 15, 10, 10. Those 5 numbers are the entire skeleton of your credit score. Memorize them, because now I'm going to walk through the myths and you'll see why each one is wrong. Myth 1. You need to carry a balance on your credit card to build credit. This is the single most expensive myth in personal finance, and I've lost count of how many people I've seen repeat it like it's gospel. It's completely false. The scoring models do not reward you for carrying debt. They reward you for using credit responsibly, which includes paying it off. If you charge $300 to your card this month and pay it off in full before the due date, your credit score is perfectly happy. You also pay $0 in interest. Carrying a balance costs you interest, does nothing for your score, and trains you into a debt habit. Stop doing it. Myth 2. Checking your own credit score hurts it. Wrong. When you check your own score through your bank, through a free credit monitoring service, through Credit Karma, through any of the apps that show you your number, that's called a soft inquiry. Soft inquiries are invisible to lenders and have zero effect on your score. You can check your score every single day if you want. It will not cost you a point. What counts against you is a hard inquiry, which only happens when a lender pulls your credit to approve you for new credit. Big difference. Myth 3. You only have one credit score. You actually have many. Each of the three credit bureaus, Equifax, Experian, and TransUnion, has slightly different information about you, and each can produce a different FICO score. On top of that, FICO has multiple versions of its scoring model. Version 8 is most common for credit cards. Version 2, 4, and 5 are often used for mortgages. There's also FICO Auto, which is specifically calibrated for car loans. And there's Vantage Score, which is a different company entirely. So if your Credit Karma score says 720, but the mortgage lender pulls 704, that's not a bug. That's two different models looking at slightly different data. Myth 4. Closing old credit cards improves your score. We already covered this, but it bears repeating because this advice is everywhere and it's poison. Closing an old card shortens your credit history and reduces your available credit, which raises your utilization. Double damage. Unless the card has a fee you can't stomach, keep it open. Use it once a year to keep it active. Done. Myth 5. Paying off collections removes them from your credit report. Here's where the math gets brutal. Paying a collection does not automatically delete it. Depending on the credit scoring model, a paid collection might look better than an unpaid one, but it might still drag your score. And some older scoring models treat paid and unpaid collections identically. The only reliable way to get a collection off your report early is to negotiate with the collector for what's called a pay for delete in writing before you send any money. Many collectors will not agree to this. Some will. If you're dealing with a collection, your leverage is higher before you pay, not after. Myth 6. Your income affects your credit score. Nope. Your income is not on your credit report. It has zero direct impact on your score. What income does affect is your debt-to-income ratio, which lenders calculate separately when deciding whether to approve you. You can make $300,000 a year and have a credit score of 580. You can make $40,000 a year and have a credit score of 830. The score doesn't know and doesn't care what you make. You might be thinking, wait, if income doesn't matter, why do credit card applications ask for it? Here's why that's not the full picture. Lenders use your income to decide your credit limit and whether to approve you in the first place. But that's separate from your score. The score itself is built entirely from your payment behavior and credit data, not your paycheck. Myth 7. Debit cards build credit. Sorry, debit cards are not credit. You are spending your own money. There is no loan being repaid. The transaction doesn't report to the bureaus. Your debit card activity is invisible to your credit score, no matter how responsibly you use it. If you want to build credit, you need a credit card, or a secured credit card if you can't qualify for a regular one, or a credit builder loan, something where you are borrowing and repaying, which is the only behavior the scoring models can actually see. Myth 8. Bad credit is forever. Also false. And this one matters because I've met people who have basically given up on their credit because they think it's permanently ruined. Most negative items fall off your credit report after 7 years. Bankruptcies, the big ones, can stay for 10. But here's the part that changes everything. The impact of a negative item fades long before it falls off. A 30-day late payment from 6 years ago is barely hurting your score anymore. A collection from 4 years ago has maybe a quarter of the impact it had when it first hit. Time is on your side. Behavior is on your side. If you're in a bad spot, the recovery is not a lifetime project. For most people, it's a 2 to 3 year project of boring, consistent, correct behavior, and your score will come back. Now here's what changes everything. Once you understand the 5 factors and the 8 myths, the actual playbook for improving your credit score is embarrassingly simple. It's not a secret. It's not a hack. It's 4 things. Pay every single bill on time. No exceptions. Set up autopay for the minimum payment on every card and loan you have, so you cannot accidentally go 30 days late. Then pay more than the minimum manually if you can. Keep your credit utilization under 30%. Under 10% if you want to be in the elite zone. If you're running high on a card, pay it down before the statement closes, not just before the due date. The statement balance is what gets reported. Don't close old accounts. They are quietly padding your average age of accounts and your total available credit. Leave them open. Use them once or twice a year. Only apply for new credit when you actually need it. Spacing out applications by 6 months or more is ideal. Rate shopping within a 2-week window for big loans is fine. Random card applications every other month are not. That's it. There is no fifth secret move. There is no special trick the rich use. There is no elite credit repair company that can do something you can't do yourself for free. The entire game is just those 4 behaviors, applied consistently over time. Here's the part I want you to hear, because it's the part most credit content never says. You are not behind because you're bad with money. You are not behind because you lack discipline. You are behind because nobody ever sat you down and explained this clearly. The credit scoring system is deliberately opaque. It rewards people who happen to absorb the right information from their parents or their bank or their school, and it punishes people who didn't have that luck. That's not a personal failing. That's an information gap, and you just closed it. If you take one thing from this video, take this. The credit score is not a measure of your worth as a human being. It's a measure of how predictable your borrowing behavior is. That's it. Become predictable. Become boring. Become the person who pays on time every month, uses a small fraction of their credit, and doesn't chase new accounts. Do that for 2 or 3 years and your score will be exactly where you want it to be. The math is not mysterious. The behaviors are not complex. You just needed somebody to lay it out without the nonsense. If this video helped you see things differently, drop a like. It actually matters more than you'd think. And if you want more straight talk about your money, hit subscribe. Mr. Bandage drops a new video every single day. I'll see you tomorrow with another one. Money hurts. I help.